Okay, so just wanted to say hello to everybody and welcome to the last monthly presentation of our meetup group. And just looking back, we've had this meetup group now for 5 years. I checked the numbers right before the meeting. We're up to 582 members, which is pretty good considering I think when I started it 5 years ago, I think we had our first meeting, we had 3 or 4 people in it. And so we've come a long way, and we were able to hold meetings all the way through the pandemic. And what we'll probably do next year is we'll go back to live meetings, but we'll also do some remote meetings. So like once a month we'll do these meetings because it's really good to reach out to people kind of all over the place. So that's kind of my plans. We'll talk, Dennis and Eric and I will talk about how do we make that happen. So anyway, so today I wanted to talk to this group about a gap trading strategy, or just gap trading in general. And I'll just start off by saying that I'm not an expert in gap trading, but I will say that I did read a pretty interesting book that kind of opened my eyes to how to potentially trade gaps a little differently than I have been. And I really just wanted to share it. So I encourage everybody to ask a lot of questions, and I may not know all the answers because, again, I'm brand new to some of these new strategies, but I thought they were really interesting, and you guys might be able to kind of start adding this into your practice. So first of all, just a risk disclosure. This is for educational purposes. We're not providing financial advice. And we all know that options can be risky. All you had to do is trade options the last couple of weeks to know that. So first of all, just wanted to start at a basic level. What are gaps? And really, it's pretty simple. It's really just the difference in price from the previous day's close to the next day's open. And almost every single stock or ETF will have some gap of some size. It closes at 100 and 100 on the dot. It may open at 101, or it may open at 99.50. That's a gap. It can also open up 10% different. So gaps are really just the difference between the previous day's close and the next day's open. And most people consider a gap above the previous day's close as bullish, and a gap below as bearish. So that's pretty basic. And so I wanted to talk about what causes gaps. And it's really a whole bunch of stuff. If there's some bad news or good news about a company or something that they're working on, that could impact the stock. It could just be the whole market is down. Like we woke up, what was it, the other day, and the market was down 1.5%. Everything pretty much gapped down that day. There were a few that gapped up, but sometimes just the general market will make a stock gap. The biggest kind of thing, or the most common, is earnings announcements. When a stock announces earnings, it's pretty much guaranteed it's going to gap. If it has good earnings, it usually gaps up. If it has bad earnings, it will usually gap down. Not all the time. Sometimes you'll have good earnings and it'll gap down, and vice versa. Anything related to medical, FDA approvals are kind of notorious for gaps, especially kind of the rumor of FDA approvals or testing. And then just, feed or greed. All you got to look at is, the meme stocks. they gapped up. If you look, and I'll show you some sites that you can see what stocks gap, but a lot of times you see the exact same names every week, every day. GameStop, Beyond Meat, AMC, you'll see all of those. They're going to gap up all the time. And it's mainly just depending on if they're buying or selling. So those are kind of the reasons we have, or what causes gaps. And kind of the main thing is that all gaps aren't equal. So, what this presentation is kind of designed to do is take a way or present a way that we can look at gaps, score them or rate them, look at kind of how do they look, where did they come from, so we can trade them better. So that's kind of the purpose of the presentation. So before I go to the next slide, any questions from anybody?
I have a quick question.
Yeah, Tom.
Would you say that the gaps a lot of times are based on like social sentiment, like what's going on with the news, like Elon Musk tweets something, like
oh yeah,
or like all that stuff like that?
Yeah, anything, anytime they mention a company, if they talk about Tesla, good or bad, it could impact how it trades overnight. And if there's good news about a company, then it will tend to go up. If Jim Cramer says we need to be buying PayPal, it's going to gap up. I can just based on that. So yeah.
Sometimes you can almost look at the chart as he's talking and watch it with your own two eyes, right?
Yeah, that's
on certain underlines. Yeah.
Yep, for sure. So and really kind of all gaps are different, and we'll talk about that in a second. So
so one other question in similar regards, all the earnings trades that we do together and stuff, usually we stay away from putting it in, entering the trade like a week before or a week after. But I mean, correct me if I'm wrong, because I haven't traded in a couple of weeks, but have we not been doing that, or have you not been doing that? Have you been entering more trades, not, let's say, following that rule where it's a week or so out, like just because the market has changed?
Yeah, I mean, I think, earnings are kind of a guaranteed that it's going to gap up one way. So unless I specifically trade it to take advantage of the earnings, I would avoid being in a trade through an earnings event. But
so get out, so get in, make enter the trade and get out before. Basically the same, going by the same rules.
Yeah,
okay. Right.
Yeah. And what this is kind of saying is gaps are kind of a result of an earnings event. So
yes.
And one thing that I can tell you about earnings are you never know. You have to, you can have a great company, you think they're going to have great numbers, and they just have terrible result after the earnings. So, but what we really want to focus on today is the gaps. And this could be, and a lot of times, like I said, is right after earnings. So, one of the in the book, and I'll show you the name of the book at the end, but it's finding a way to kind of rate or evaluate gaps. So the author came up with a rating system for identifying high quality gaps, talking about what quality gaps give us a high probability of trade setup. And what I would say is most gaps kind of follow a very defined pattern. If it's a certain kind of gap, it's almost guaranteed to kind of fade the gap at some point. And if it is, a certain type of gap, it's going to just continue. So it's kind of based on not only kind of what we think is going to happen, but what has happened in the past on similar kinds of setups. You mentioned about the psychology of the masses. If everybody is bullish on a stock, it's going to go up in price. But the other thing that in terms of psychology is if you're holding a stock and you paid $100 a share for the stock and now it's at 120 and you wake up the next day and it's gapped to 140. There's a lot of people who would say, as soon as I hear the opening bell, I'm going to collect my 140 and put that in the bank. So there's a lot of that kind of psychology that if a stock goes up or down to a certain amount, people are going to take action. And so that's one of the reasons that, that is a big part of how you trade gaps, is kind of trying to estimate what the masses or what the other guy on the other side of the screen will be doing if he was holding shares and the stock either gapped up or down. So that's a big part of it. So really there's two main types of gaps. One is called a professional gap. And what that is when a stock gaps against the existing trend with high volume. So you can take a stock that's been either going up or going down on a pretty solid pattern, and all of a sudden gaps the exact opposite way. So that would be considered a professional gap. And what that generally means in a lot of cases, not every time, but it changes the long-term direction or trend of the stock. So, you can take a stock that has been going down, and then all of a sudden it gaps up and then starts to move higher. So that's kind of what we would look for if we were looking for a professional gap. And these are the kind of trades that really kind of kick off a new trend. So if you see one where it's been moving one way or the other, and then it reverses the opposite way with high volume, then I would be looking and evaluating it for a kind of a reversal in the trend. So that's a professional gap. And the other type of gap is called a novice gap. And it doesn't mean it's not professional, it's just a different, it's one's A, one's B. So a novice gap usually, or it will gap in the direction of the trend, of the current trend, and then generally reverses back. So if the stock is going up, a novice gap would gap higher, and then at some point start to reverse and revert and give back that gain. So that, and almost all novice gaps reverse after the market opens. So that's really the main difference between a professional gap and a novice gap. So one is probably more rare, the professional gap, because it's going to be a complete reversal of the trend. And the other one can signify the end of a trend or just a pullback. And what happens in if a stock is going up and it gaps up, then sometimes what you'll see is if it's a highly shorted stock, people will have to start buying to cover their shorts, or people will start to add in and add to their position. So that's the main difference so far, just professional gap, novice gap. Any questions on that so far?
Yeah, Brian?
Yes.
Kevin here.
Hey, Kevin.
How's it going, buddy?
Good, good.
All right, so on this professional gap, when it goes completely against the trend, would that be considered something that may have to look for a couple days or so for a swing style, or are we talking about kind of like what we do in the in the room, the chat room, when we just kind of get in and get out sometime during the during whatever the gap call is?
Yeah, that's a great question. This is more of a longer term trade. If you see, not that we couldn't enter it, right away, but it's kind of one where we might say, this is a reversal of the trend. We're going to go in the new direction, but we're going to stay in it potentially as long as we want to. If you were buying shares, you might buy shares on that reversal. If you were buying options, buying calls, if it was going back up, you might go longer out, maybe 3 months out kind of time frame.
Thank you.
That's a great question though, because this is kind of what opened my eyes to when I have been trading gap trades. It's really kind of more that short term. What's the stock going to do after the market opens? This is kind of saying that if we look for the right kinds of gaps, we could find good long-term investment trades. And, so we can set it up and say, if this is a professional gap, maybe we do a 45 to 75 day credit spread on the trade versus a 1 day, debit trade.
Nice.
Okay, so that's the difference between the professional gaps and the novice gaps. So here's kind of probably the 6 kind of behaviors of gaps, and we'll go through all of these kind of one by one. But I just wanted to go because we'll be looking at every gap according to these behaviors. So the first one is, where is the stock gapping to? So it could go up or down, but where is it in terms of the long-term chart? The second piece is, where is it gapping from? And we'll talk about that. It's kind of like if the stock is in a downward pattern and it gaps up, that's kind of that's telling to some degree. The third one is kind of one we all probably know. What's the shock value in the gap? If a stock totally, beats, surprises everybody, there's a way to kind of gauge that to see how well to trade that type of gap. The fourth one is, what's the size of the gap? Is it too big? Is it too small? That kind of thing. And does it get past existing support and resistance? So that would be the size of the gap. And then the fifth thing is called, is the stock gapping into a void? And what I mean by that, or what the author kind of uses, is if it gaps up beyond a resistance level, what's the next resistance level? So that's kind of that void between, resistance level 1 and resistance level 2. That's important. If something gaps right into a strong resistance level, it's going to have a harder time succeeding. And then the sixth item is kind of relative strength or weakness to the broader market. And again, we'll go over all of these in detail. So the first point was, where is it gapping to? And so this is the key, is you want to look at a stock. It gaps up, and then if you look at it on a daily chart or a weekly chart, however you trade, and there's a strong resistance level right where it gapped to, then there's a pretty good chance it's going to, fade the gap. It's not going to break through if it's been a strong resistance level. So the ideal kind of gap is, we want it to gap above a resistance level or below a support level. That has a higher probability of being successful. The next one is, where is the stock gapping from? So if you look at the original stock, you want to know, is it gapping from a green candle or a red candle or in some kind of a pullback? And so, that's important. And we'll look at that again in a little bit more detail. And then the third point was the shock value. So the more, surprising the move, the greater the shock value. So if you see a stock that's gapped up or maybe made a really strong run and everybody thinks it's going, to the next, target level, and all of a sudden it has a major gap down, well, that's going to be a major shock value, especially to those people who bought shares as it was going up. And the author kind of talked about the more traders that are trapped in a gap, basically by surprise, the more likely the stock will move in the direction of the gap. So that's a little bit of that psychology of the trade. If you were in this trade and it bought it at 100, now it was 90, what would you be doing? Would you be throwing in the towel and getting out at 90? If that's the case, then it's going to go down further. If people jump in and want to buy it, it's going to, reverse the gap. So that's the shock value. So the greater the shock value, the more it's going to move in the direction of the initial gap. Any questions on that part? I know that was a lot of information on one slide. Everybody got it? Okay. Okay, the next part is the size of the gap. And I really never looked at this before kind of studying this book, that, if a stock gaps up, what you want to know is where's the resistance level of that stock on a daily basis. And if it's above that resistance level, then that's a great gap. If it's right up to a resistance or right just below it, it's probably not going to be a gap that's going to go, continue on. So that's kind of the size of the gap. How much, did it move compared to the resistance and the support level? And is there enough room to move in the direction of the gap? So that's kind of the size of the gap. The second thing is, if it does clear the gap or the resistance or support, how much room do you have before the next level of support or resistance? So that's going to tell you how much the stock could actually move between, where it gapped to and what the next support or resistance level is. So to me, that was eye-opening when I kind of read that and studied that you can kind of look at that. And Ron, did you have a question?
Yes, I did. Thank you for sharing this insight on gap, because it's
Sure.
really a nice a mystery that we always try to solve. What happens between 4 p.m. and 9:30 a.m. the next day? So when you say resistance and support, are you talking about the resistance support that occurs in that gap, or prior to that, or further back? How far back are we looking at resistance support?
Yeah, it's prior to. So we would be looking to see, is the stock have a clear, resistance level, say at 110, and if the stock gaps to 108, then it didn't clear that resistance level. So
Right,
you
but
can
is the resistance, because let's suppose, and I'm a person that likes examples and visualize and actual.
And I'll show you. I had a chart of a trade I did today that I'll show you, but it is try to answer your question. It's the before the gap started, what would be the, if you were drawing on the chart, what's the resistance and support level? And then when you wake up at 9:30 in the morning and it gaps, did it clear those either of the support or resistance level?
Okay, I'll wait for your example.
Okay.
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 Thank you.
Sure thing. Great question. And then the sixth item on the behavior of gaps is the gap, into strength or weakness. And what I mean by that is if the market is bullish, a gap down would be relative weakness. So, so that would be kind of a case where we would say it's relative weakness. So we would short the gap because it's weak compared to the general market. And if the market is weak, a gap up would be a good candidate for a long trade. Should have said long, I said ling, but so you want to look at kind of what's the overall market in addition to the gap. And if the market is bullish and you see something gap down, then that's relative weakness. And if the market is weak, and this one just blew through the gap, then we want to be looking at it from a bullish standpoint. Does that make sense, everybody? Okay.
Yes.
Okay.
Yes.
So here is, so there's 3 categories of gaps. So 1, 2, and 3. And so 1 is obviously the highest possible rating. So these are kind of trades that are kind of your ideal trades that, if you see this setup and it kind of meets all of the criteria, this is a trade we want to look at from a long standpoint. And if it's a category 1 down gap, then we would go short. And we haven't even talked about options, and I'll talk about that just in a little bit at the end, but you could trade these gaps pretty much any way you want to. You can buy the stock, you can buy calls if you want to go long, or you could sell puts. And I think there are certain situations you'd want to do one or the other. But first, let's just talk about the gap. So in a category 1 up gap will actually gap over 1 or 2 big red candles on a daily chart. So if you look at a chart and you see it's had a couple of red candles and it gaps above that, that is kind of what kind of a category 1 gap would be. The second thing is that it gaps over 2 or more pivot points. And pivot points, what I mean by that, these are just kind of bounces up to the resistance level. So if it bounces up to the resistance level and doesn't get above it, that's 1 pivot point. And if it does it at least 2 times prior to the gap, that's kind of the ideal setup. And then the next thing is it gaps up enough to clear consolidation or resistance. So that's kind of like what we're looking for. We want this gap. It hasn't been able to get above this consolidation or resistance. And then all of a sudden, boom, we wake up and it's blown through those numbers. And then the next thing is it gaps into a void. There's enough room after the gap to the next level of resistance, or if it gaps down to the next level of support. And then we want to see relative strength. We talked about what that is in terms of a gap, category 1 gap up. Does that make sense, everybody? It's a lot of info. And one of the things that I'll be working on is kind of a checklist that we can look at these trades and kind of go through and say, yes, it did this. Yes, it did that. So we can score these more, objectively. So here's an example. So this was a trade that happened today, and this was in MU. So this was an up gap, and even though it happened just today, if you look at the chart, you can kind of see what some of the categories are. So if you look over here, you see these 1, 2, 3 red candles. Y'all see that? And then here's the consolidation, right? So what the stock did is it blasted through the consolidation. And if you look up here, here's your next level of resistance up to the, the 96 level. So, even though it was a recent trade, it was almost, in my opinion, a textbook trade in terms of a category 1 trade. So this is a trade that could easily run up to that 96 level. So you could either trade it by buying calls, buying the stock, or selling puts, whichever kind of makes sense. In this particular case, since it just had earnings and IV was super high, selling a put spread would make sense from an option standpoint because you'd have the IV crush. Meaning after the announcement, the IV will reduce and that helps our pricing. So is that an example help, Ron?
Actually, I'm trying to see, you're looking at it on a daily, right?
This is a daily, right?
So I'm trying to understand, I see the candles, but I've thought the gap is what happens from 4 p.m. the day before to 9:30. So
right. So here, if you look at this right here, where it had this little red dot, basically a doji candle. The difference from here to the bottom of the green candle, not the wick, but that is your gap.
Okay.
It closed here. It opened here.
Right.
So if we looked at it on an hourly chart or a 15-minute chart, you would actually see, a big, but this is, this right here, this area here is the gap.
Okay, yeah, but I'm trying to figure out from the points that you were showing earlier, how would you figure that it's going to take that direction?
Well, you don't know it's going to take that direction until it takes the direction.
Right.
So when you wake up, and you see where the stock opened up this morning, it's going to be right here.
Mm-hmm.
So if you look at, the criteria, here's your consolidation or resistance. You've had multiple red candles prior to it, and then it gapped over that.
Yep, I see that.
And then you have kind of this room from here up to this level when you don't have any resistance. That's called the void.
Yeah. That's the way. I got it.
Does that make sense?
Yeah.
Yeah.
And and they're not all going to work, but this is kind of was an ideal kind of as I was preparing this, I said, well, shoot, I did the MU trade today, and it kind of, the candles, almost looked like the textbook.
Right. And right now, your next resistance line, if I'm looking at the chart correctly, is roughly 96.
96. So I've got another, whatever, 5%.
Yeah. $6 or change.
Yeah. So, and if you did it as a put, a credit spread, a put spread, you could have sold, something even down here or even up, something like that, and made a nice, the odds of that, reversing down are pretty slim. Kind of, the best way to enhance your odds is to see a situation like this. And you could, you could have bought the stock at the open. You could, buy the calls. You could sell puts.
Mm-hmm.
So anyway, I did make a copy of a slide. It was from today too, so it helped me remember what actually happened. So, okay. Any other questions? Okay. So category 2 are, not as generally as strong of a gap as your category 1, and they will, gap over smaller candles. They should have at least, again, 2 pivot points, but they don't have to be as, they aren't going to be as dramatic as maybe the previous chart. And the same thing, it's going to gap above consolidation and have room to run. And relative strength is important, because if if we're looking on a down gap and it gaps down on a day the market is up, that tells you that there's a lot of relative weakness. So those are so these are probably the two main gaps that in reading this made the most sense to me. For these are tradable gaps. If you see a category 1 major gap like that, that's kind of a trade I think is worth kind of reviewing and seeing if the numbers work. If you see a professional gap, that's kind of a trade you want to look at from a longer term. The next category is category 3, and these are they only they gap up from a green bar or down from a red bar or candle. They're only gapping above. They're only gapping over one pivot or a small consolidation. And sometimes these kind of trades gap more than necessary. It's kind of like a trade on a weak stock fundamentally, and it gaps up 15%. So these kind of stocks, in my opinion, would be good trades to basically fade the gap or fade the reverse revision back to the mean. And a lot of times these will gap up and there really isn't any void. Like maybe like in the previous thing, it could go from 90 to 96. This would be if it went from 90 to 91. There isn't really enough of a room to really make a trade. And it doesn't have relevant strength. So I didn't even talk about, how do we trade these guys, just because I don't really think, I would rather focus on identifying category 1, category 2 gaps and trade those and just eliminate the, just don't even bother with the small gaps. Unless you want to do the day trading, those are probably perfect for that kind of a thing. So in this, on trading category 1 gaps, the system that was set up or explained by this author, and you could take this and modify it to your own strength, but what he waits for the first candle to be finished, and he was talking about 1 minute candle. I added 1 minute to 5 minutes. So now these are those category 1 gaps. So they're big, kind of gaps. And what he does, and he's not an option trader, so he's a stock trader, but it's still a gap. So he looks at the first candle and he kind of bases the trade based on if it breaks above the top of that first candle, he's going long, and he's exiting if it moves below the bottom of the first candle. So that's kind of his methodology. And so he, goes long when the stock moves above the first candle. And so these are category 1 trades. So from an options trader, if I see a category 1 gap, I'm going to be if it's an after earnings, I'm probably going to sell a put spread. If it's a shorter trade, I'm probably going to buy a call or buy a call spread. And then I would exit when, if the gap, faded and it moved below, then I would say that it didn't work and I would exit the trade. So the good thing on these kind of trades are you get in early. And one thing you can do is you can kind of scale into a trade. So if you do, say you do 5 contracts, you could do 1 early, add to it, and get your 5 trades in. So so that's kind of how one recommendation on trading category 1 gaps. Any feedback or comments on that?
It'd take a little time to study it up and work
Yeah.
it in. Pretty good.
I
That's good stuff. Makes
And
a lot of sense though, yeah.
it really does. And, it's funny because I studied this book and, obviously it wasn't about, how to trade the options on Gap. So I kind of said, well, how would I add, take this knowledge and build, an option strategy. So, my thing would be if I thought it was going to go long, I would buy a call and treat it like a kind of a synthetic stock. And if it moved below that first candle or even wherever line you kind of draw, that would be your exit point. The other thing that is kind of really important here is, things like bear flags or bull flags or breakouts. So if a stock, gaps up and then it starts to pull back, if we study kind of what a bull flag is, and you can kind of time your entry based on that. So if it gaps up in that first minute and pulls back, or first 5 minutes, and then breaks through, that's kind of the ideal time to go long. So so if you haven't studied bull flags or things like that, then this might be helpful in terms of gaps as they go up. The other one is a breakout, and it's just simply if it gets to a certain level, and if it gets through that level, it's going to generally go higher to the next kind of resistance level. So, and you'll see that even if you're on a 5-minute chart, it might get to a certain number, and then it breaks through that number. That would be the ideal time to place the trade. And your exit would be if it broke below that previous resistance level. Any questions before I go to the second category?
What book are you referring to? I'm sorry, I came in a little late.
I'll show it at the end, Mike. But it was a book that I got on Kindle Unlimited, and it's a short book, and but it really opened my eyes, and I said, well, I need to do a study, a presentation to the group on this, because to me it was stuff that I hadn't ever considered in terms of gaps.
Is it one of the, what's the name of the author?
Let me get it here real quick. Okay, it is, sorry. It is called Trading Gaps for a Living. And the author's last name is let me get it, sorry. Actually, let me do this.
I didn't mean.
There it is, right there. Can y'all see that?
Yeah.
Raman.
Yeah, that's why.
Rashid Raymond, okay.
Yeah, so I thought it was a great little book. If you have Amazon Unlimited, you can get it for free. And I'm not trying to get people to buy the book. I just wanted to share the results, but that is the name of the book.
Good.
Okay. So, okay. Okay, so just moving along here to, so trading category 2 gaps, what we would probably want to do is use more of the 2 or 5 minute candles, a little bit more, give it a little bit more time to kind of figure the what it's going to do after the open. And if you wait that 5 minutes or 10 minutes and it breaks through the higher level of the candle, we would go long. And if it breaks through to the bottom level, we would go short. And Kevin, that's a strategy we do in the chat room all the time. You know, we kind of either it's a gap or go, or it is a, you know, fade the gap kind of thing. So very kind of common trade. So
And Brian, what is the success rate of that theory?
it's pretty good. And I would probably say 70% wins, 30% losses.
Okay.
And the one thing that I'll just qualify that, what I kind of found is if a gap works really well, you can let that thing run pretty much all day long. If it doesn't work, you're out of the trade for a minimal loss.
Exactly.
So yeah, I'd probably say, Kevin, what would you see them all the time? Would you say
Yeah, I was
2/3?
thinking like I was thinking 60 to 70%, but yeah. And the big thing is, you know, if it goes against, you know, as we get to the, you know, the lower part of the opening bar, if that's the low, then, you know, see you, get out.
Yeah.
That's what I do. I just wait. If it doesn't, you know, if it doesn't make it, I'm not hanging around. Even if it turns back around, I just kind of, you know, in the first half hour, I'm not hanging around. But yeah, it's very good. I mean, it works 60 to 70%, I think.
Yeah. So okay. So did that answer your question?
Yeah, somewhat.
Yes, yes.
Somewhat. I'm
Okay.
still digesting.
Yeah. And to me, it's kind of, I read this, and it's not a long book. I read it like 2 or 3 times. And for option traders, you have to kind of take the information and kind of apply your option strategies to it. But the concepts, in my opinion, make a lot of sense and it's worth kind of digging into. So the other part was, how do you find gaps? So there's a couple sources, and I was happy that both of the sources that he recommended were sources that I use all the time. To me, the best one is marketchameleon.com. And there's a pre-trading tab that comes out every morning, I think around 8:30. If you go too early, there won't be anything in there. So at about 8:30, you go to the tab that says, you know, reports / pre-market trading, and you'll see all the stocks that gapped up or down that particular night. And you can also see the most active as well. So the most volume. And what I tend to do is I go through this list, and I generally eliminate any stock that's under $20. So I skip them pretty much all the time. And then I'm looking for how much volume was there and what's the market cap of the stock. And what's really cool about, you see where it has an N or an E on under the alerts? You can actually hover over that and it will give you information about the stock and what happened. So an E is an earnings event. So you could see here, this, you know, this was actually, I took this snapshot this morning. So you can see MU was on it. It gapped up 8.2%. It had a, you know, 227,000 in volume, and it's got a giant market cap. So, so that is, and then it had an E and an N for news. So, and, you know, and Nate pointed out that, you know, that in this particular case, the volume was 3 times the average. So, you know, when we talked about we wanted a gap with high volume, this was kind of your poster child of the day. And Rod asked, you know, do I trade during market hours mainly? Yes. I don't do any after hours trading. But so in terms of finding gaps, this is probably my favorite source for looking at it. And again, I just go through them and I'll try to pick out maybe 3 to 5 up gaps and down gaps from here based on that criteria. Marketchameleon.com, and it's free, so you don't have to pay anything for it.
It's free. Wow. There you go.
Free. That's even better, right?
My favorite.
Yeah. And then the other one is Market Watch. And it is Market Watch Tools, Screener, Pre-Market. If you want to just find it quicker, just Google pre-market movers and you'll get all of those guys will pop up. So, and this one will give you the name of the company, the price, the volume, and the change. And you know, one thing that was pointed out in the Market Watch is if it doesn't make whatever the top 10, it won't be on there. So Market Chameleon will give you maybe 30 stocks. This one will give you whatever 10 or whatever they have on there.
And Brian, that's the percent change from the closing of the previous day to the current pre-market condition?
That's correct. That's exactly right. Yeah.
Thank
So
you.
you could see, and you can tell, you know, one thing that I'll look at, if you look at this and you say the biggest down gap yesterday or this morning was 3%. So you know that it's going to be a bullish day. If you wake up and everything is down, you know, 10%, 12%, 8%, well, then, you know, the whole market may be in line for a down day. But if you want to do it the quick, easy way, just Google pre-market movers and you'll get all of these as ones you can pick. And there's more. These are the two that I use the most. And then the only other thing that I will do regarding the gaps, I use a website called investing.com, and it will have in the morning kind of a story about, you know, these 10 stocks, this is what happened. It'll say MU beat earnings and is up 8%. You know, so-and-so, their CEO is leaving, it's down 2% or whatever, you know, the news of that. This one got upgraded, this one got downgraded. So you can get a little bit of news on those kind of sites. CNBC does the same thing. So I'll go there as well. So is that helpful?
Yeah.
Okay.
Very good.
So in terms of what I kind of recommend when you trade gaps is you want to have kind of a set routine to do these trades. And one is, you know, use your scanners. And and let me back up. The Thinkorswim and a lot of platforms will do scans as well for gaps. So you could use that as well. So what I do is I will list 3 to 5 up gaps and 3 to 5 down gaps that kind of meet, you know, stocks that I'd like, you know, they had enough volume, they were over $20, and I want to look at them in more detail. So the next thing I do is go to the option chain and see what liquidity some of these stocks have. And that'll eliminate about half of them. So now I'm down to about, 5 stocks. And then I kind of write, a plan and say, this is a gap and go trade. This is a gap fill. This is, the way I think I will trade the stock. So I kind of have a game plan at 9 o'clock in the morning on what this stock, how I think I'm going to trade it. And then I kind of pick a couple, 2 or 3 at the most, that I'm going to look at that morning. I don't try to trade, 5 or 6. I look at, 2 to 3, and I pick one, and that's my gap trade for the day. And the last thing I would say, and it's really not pre-market, but after the market, is be patient. Wait that 5 minutes, wait that 10 minutes, wait for the pattern to kind of set up, because a lot can change in that short period of time. And once you've identified, like I said, 2 or 3 candidates, you'll see pretty quickly which one you want to trade that day, if you want to make any trades. And then you want to make sure that as you're getting ready to set that up, you know when I'm going to enter it and when I'll exit it, because we're going to be trading options, or I trade options on these, but I will be looking at the underlying stock or ETF. And that is what I have for gaps. Any questions, anything that didn't make sense, or?
Looks good. I think we'll get that book for $12 or $13 or whatever.
Yeah. And it's a nice little book. I mean, you know, I think, you know, it opened my eyes in terms of being able to look at gaps a little differently than just quick day trades. So
Yeah, right.
that was kind of the main takeaway for me. And here's the book. And again, I'm not selling it. I didn't pay anything. I have the Kindle Unlimited, so I just read it. So, but it's a good book. It's well worth, the cost of it, and it is not overly technical. It's pretty simple, and you can build your strategy around it. Dennis.
Brian, yeah. As far as this book is concerned, Brian turned me on it. I think it was Saturday or Sunday. And if you do not have Kindle Unlimited, you can get a free trial of Kindle Unlimited for 30 days. Get the book, read the book, and then decide whether or not you want to stay with Kindle.
Nice job.
I took a couple of screenshots of a couple of pages in the book as far as setups and things like that. So it's a good way to get the book and get introduced to Kindle Unlimited, for those that like books.
Yeah. Thanks, Dan. You know what? And I generally will get a lot of these Kindle Unlimited because there's a topic that sounds real interesting. And I'd probably say 9 times out of 10, I pitch them back within the first hour. This one was a little bit different, and mainly because it just opened my eyes to how to look at gaps differently.
Good, nice.
Okay, anything else? I'm gonna stop the sharing so I can see everybody. So I hope you guys have enjoyed it. I'm gonna stop the recording.